Okay, greetings. It's Friday morning. I had a chance to get some sleep, and we're going to try to do the formula someone asked about the other last night for how this works. But first, the story. Let's take a look at this. A very famous story. Someone says, I got this $1 million idea. Everybody wants a Rolls Royce, but they don't want to pay the price, so because they're too expensive. All right, so here's the idea. Sell them for $999.95. So how's that going to work? Well, so you can see the punchline coming up. You make it up in volume. Yeah. Well, I think through this course, even before this course, you all knew that this was a joke, and you understand why. But nevertheless, it's what we're dealing with. We're really dealing with what does volume do, what does volume not do, and other factors involved. So let's get to the whole idea. We've been talking about something called the contribution margin, and every time we come across it, what I've been saying to you is it's the same thing as gross profit. Well, yes and no, and that's where this gets to a little bit of, we got to now undo the shades of gray and make it perfectly clear. Contribution margin is a particular part of the calculation of what we call gross profit. So I've been saying it's the same as gross profit to be able to drill into you that we're really looking at sales minus cost of goods sold, but only a particular part of cost of goods sold. Let's see what we mean by that. This is, if you've had financial accounting, you'll recognize this. If you haven't had it, then just bear with me for a second. This is a typical real financial statement outline of a business profit and loss statement, income statement, where you show the sales, you show the cost of goods sold, and then you get to what we actually call the gross profit, which is the difference between the cost of goods sold and the sales, as you see here. $400 is the profit made on the sales. And then we apply, in an accounting sense, the overhead, all the fixed costs, and sometimes sometimes they're step fixed costs and things like that, but they're the fixed costs of selling, general and administrative. Sometimes they're variable costs in here. So that's another thing that you need to understand, is that sometimes there are variable costs in this particular, like could be sales commissions or commissions for advertising expenses and things like that. So there could be some variable expenses, some in the SG&A. So this is really a financial approach to a business's income statement. And the operating income, pay the taxes, maybe they need a better accountant to get that number lower, and then they get the net income. So that's your financial statement. This is typical income statement. What we're really dealing with is in this course, and in this chapter in particular, is the contribution margin. This is the formula. This is what, if you keep this in mind, then you can really see where we're going, which is a different way of looking at the net income. Now notice the net income over here is $200. Where we're going here, it's going to be the same thing. We're just going to break down the analysis differently. The sales will be the same number, not a problem. But then we want to start analyzing the various types of costs we have. Let's take the variable cost off first, and that's what we get called the contribution margin. Contribution margin meaning contributing to overhead. Contributing to overhead. Or fixed costs. Or unavoidable costs. All the same thing. And that's why, at this point, you see $600 as the contribution margin, and there's your fixed cost. Those unavoidable costs give you an operating income, pay the tax, and you're at the same bottom line. This is a different formula than the financial statement, profit and loss statement, but this is the formula we're dealing with. We first want to know all the variable costs, then we take away the fixed costs, and we get our operating income. But in between those two concepts, is that all-important contribution margin, which is the amount that is going to cover fixed costs, cover the overhead, cover those unavoidable costs. So when we do the calculation, we also sometimes do the calculation not just in terms of dollars and cents like you see here, but we can do the same calculation on a margin per unit. And that's what some of the problems that you've seen have been doing, taking what's the contribution margin per unit of output. And here's the formula for that. What's the contribution margin per unit? Well, it's the sales price per unit minus the variable cost per unit. And it's just simply taking the sales number and the cost number of the variable cost and dividing by the number of units to get cost per unit. It's that simple, but it's important to recognize that that's what we're doing. Let's take a look at this slide for a second. And that is that in our analysis, we often translate the dollars and cents or the unit amounts into ratios. And you can do it either in terms of sales, the actual dollars, or you can do it in the per unit. It'll come out to the same thing. That's the good news, is that if you know one, you know the other. It'll end up to be the same. Keep in mind what it means, contribution margin, that it's the sales minus the variable costs. That's what we're dealing with. All right, and then when we're working with problems with contribution margin, we often have to play with some of the variables that can exist in the decision-making process that would occur when you're deciding between A or B or C, and we're looking at all these different decisions, and we want to see, well, what happens if under A certain things happen, et cetera, et cetera. You get the idea. And the variables that can occur in the sales price, the volume, the variable costs, and even the fixed costs. Sometimes making a decision between A or B, some of the fixed costs, which are the unavoidable costs, sometimes can become avoidable, such that under A, for example, maybe 30% of the fixed costs go away, which would be nice. If that's doesn't mean that B is going to be the best choice, but it's a factor we have to take into account. And it's a indication that sometimes of the fixed costs, some of them are variable depending on what the decision of the A-B decision involves. Because the B decision may be, well, we can get rid of a part of a warehouse and rent it out to someone else, so that reduces fixed costs. And those are the variables that how these problems are working. So what we're really doing is trying to solve for any one of these variables in different scenarios. And sometimes we're just trying to solve for, well, what's the best scenario given what will happen to sales price, what will happen to volume, what will happen to variable costs, what will happen to fixed. And really what you wind up doing, to just make one more illustration on this page, really what you wind up doing is you wind up taking the formula of the sales versus the contribution margin minus the fixed costs to see the net income, the formula that we've been talking about. So you take the sales minus the variable costs under A minus the fixed costs under A, and see what your net income is. And then the B is, what are your sales under the B scenario? How do your variable costs differ there? And how do your fixed costs differ under B? Is there a difference? If there is, you have to take that into account in order to figure out what the net income change would be between A and B. And keep in mind that not necessarily will these be equal between the two choices. And the problems, of course, will give you indications of how to figure out what they'll be under the A scenario versus the B scenario, so you can determine which is the best choice to make. And that's the whole idea of what we're doing with these problems. So that's the formulaic approach. And what we'll do is we'll do, I think, one more video, get this afternoon, a little bit after the lunch hour. And what we'll do is go through one or two more complicated problems using the same methodology and thinking that we've been using, but keeping this in mind at the same time.